While most of the world was sleeping, the global energy market just hit a breaking point. Over the last 72 hours, a coordinated strike by the US and Israel on Iranian military targets has triggered a chain reaction that most people haven't even begun to grasp. We aren't just looking at another regional conflict. We are looking at the potential shutdown of the world's most important energy artery. It began in Iran, strategically positioned along the Strait of Hormuz, where roughly 1/5 of the world's daily oil supply passes. The United States and Israel launched strikes on Iranian military targets. Iran responded with drone attacks targeting regional facilities and allied interests. The geography explains the stakes. The Strait of Hormuz links the Persian Gulf to the Gulf of Oman. Any disruption there can immediately affect global energy flows. For decades, this corridor has been central to both oil trade and geopolitical tension. Markets reacted within hours. Brent crude rose more than 7%, reaching $78 per barrel. U.S. oil climbed by a similar margin. European natural gas futures surged over 40% after Qatar Energy halted production. Concerns intensified when debris from Iranian drones caused a fire at the Ras Tanura refinery in Saudi Arabia, temporarily suspending operations. Even brief interruptions at major facilities can tighten global supply expectations. In the United States, gasoline prices began edging higher. Retail averages had been around $2.85 per gallon last month. Analysts now expect increases of 5 to 10 cents per day in the short term, potentially pushing prices above $3.25 per gallon as suppliers pass costs down the chain. The impact extended beyond energy. Travel and leisure stocks declined sharply. Major U.S. airlines with international routes, including Delta, United, and American, fell between 3 and 5% in early trading. Across the Middle East, thousands of flights were canceled as countries closed airspace. Jet fuel, which makes up roughly a quarter of airline operating costs, became more expensive almost immediately. Hotel operators with significant regional investments, including Marriott, Hilton, and Hyatt, also saw modest stock declines. Some Western-branded properties in Bahrain and Dubai sustained damage during the early exchanges. Inside the United States, however, security measures remained steady. The Department of Homeland Security did not issue new nationwide threat bulletins. Domestic airports continued operating under existing procedures, suggesting the immediate impact was financial rather than operational. Governments responded cautiously. Washington confirmed the military action, but avoided broader escalation language. European governments monitored energy markets without announcing major new measures. Gulf states focused on protecting infrastructure and maintaining supply routes. International organizations issued general advisories urging vigilance. Public messaging from the main actors remained measured. Israel framed its involvement as part of regional security policy. Iran signaled readiness to respond, but stopped short of announcing wider escalation. Markets interpreted this tone as tense but controlled. For energy markets, the central concern remains the Strait of Hormuz. Although Iran accounts for less than 5% of global oil production, its position near this maritime corridor gives it strategic leverage. More than 20% of global oil consumption moves through that channel each day. Even limited interference can drive volatility. Shipping operators and insurers are reassessing risk exposure. While a full shutdown remains unlikely, uncertainty alone can influence prices. Some analysts warn that if disruptions continue or expand, crude prices could approach or exceed $100 per barrel. The broader economic implications are significant. Higher fuel prices increase transportation costs, narrow airline margins, and can influence consumer spending. Travel demand may soften if ticket prices rise. Shipping costs may follow similar patterns. Regionally, the events highlight the vulnerability of energy infrastructure, from refineries to export terminals, in a geopolitically sensitive area. Each exchange forces governments and corporations to reassess contingency planning. Globally, investors are balancing gains in energy stocks against losses in travel and leisure sectors. Market volatility is likely to persist as developments unfold. The coming weeks will be critical. Further military exchanges could heighten supply concerns. Diplomatic engagement could ease them. Key indicators will include shipping activity through Hormuz, refinery operations, and official statements from Washington, Tehran, and regional capitals. For now, global supply has not been fully disrupted, but the market response demonstrates how sensitive the system remains. The next few weeks will show whether this moment becomes a turning point or fades into history.